Hey, this is Yoshi. I run a small investment firm that specializes in REIT investing, and today I'm going to answer a question that I keep receiving over and over again in my comment sections, and that's, will Realty Income cut its dividend if we go into a recession? I understand Realty Income is one of the most popular REITs in the world. A lot of individual investors hold it for its dividend specifically. You've probably seen its share price drop quite a bit in recent years. Its dividend yield expand close to 6%. And so because of that, a lot of you are worrying that perhaps the market might be seeing something that you're not, and that the company might be at risk of cutting its dividend. Also, if you followed me here on YouTube, you've probably seen that I've posted quite a few videos that were critical of Realty Income. I personally don't own it myself, and the reasons why I've been critical are manifold. The first one is that the company, in my opinion, has become too big for its own good. As a result of this, I think it's going to face diseconomies of scale. It's going to grow slower going forward because remember, net lease REIT like Realty Income grows primarily by acquiring new properties, earning a spread of its cost of capital. And so when you're massive, this becomes harder, I meant to say. Second issue is that the company is becoming a bit of a jack of all trades. You know, it used to be heavily focused on service-oriented net lease properties, but as it got bigger, there were not enough opportunities in this specific property niche anymore, and so it had to diversify across other property sectors, including data centers, casinos, vertical farmings, investing across Europe. Some people may think this is good, but historically the REIT market has priced such diversified REITs at discounts relative to specialized REITs, and the reason is simple. You know, if you specialize, you have better chances of developing clear competitive advantages. You become a real expert, you build better relationships, and this gives you a better chance of outperforming the market. Whereas when you're a jack of all trades, you cannot be an expert at everything, and there's really no value for REIT investors for the REIT itself to diversify, because REIT investors can buy many different specialized REITs to build a well-diversified portfolio. The third REIT I've been critical about is that the company is heavily invested in certain specific niches of the net lease market that I don't really like much. Those are pharmacies and dollar stores, to be specific. Pharmacies are struggling today. We simply have too many of them in the US. As a result, they are struggling. One of its biggest tenants is Walgreens. The CEO of Agri Realty, which is another net lease REIT that we own, has told us that they expect Walgreens to eventually go bankrupt even, and yet it's one of the biggest tenants of Realty Income. They're also heavily exposed to dollar stores such as those of Dollar General, and those properties often, they are more rural locations in small towns with poor demographics. These are very simple structures that often don't last much longer than 30 to 40 years. Then you tear them down, rebuild them. It's not exactly the best type of net lease properties, I would say. So I've been critical about that. Fourth, the company has some of the lowest rent escalations in its leases in the net lease peer group. They average about 1 to 1.5%. Some of its close peers like Essential Properties, Realty Trust are closer to 2%, which is at even 2% or the rate of CPI. Just like WP Carey as well, with some caps, but this results in faster rent growth. And this is a particularly big issue today as we faced rising interest rates in recent years. Finally, another risk, that I've talked about a few times is that I think that the trade war could impact Realty Income more than many of its close peers, given that, again, it's exposed to weaker segments of the net lease market. Pharmacies are heavily exposed. It has relatively low rent escalation in its leases. So that's a recap of all the things that I've been critical about. However, will Realty Income cut its dividend if we go into recession? Taking all of this into account, and my answer is no. I don't think so. I think that the dividend of Realty Income is perfectly safe, even despite the rise in its average dividend yield that you've seen. Now it's yielding still nearly 6%, but despite the market signaling to you that the dividend is becoming riskier, I think that it's still perfectly safe, and I'm going to give you 5 reasons why. The first reason is the company's track record. They've now managed to grow their dividend for roughly 30 years in a row. This includes the dot-com crash, the great financial crisis, and even the pandemic. And when you think of it, the pandemic was really the worst possible crisis that the net lease REITs could face. And that's because for a while, the tenants of these properties couldn't even operate their businesses. These are a lot of convenience stores, pharmacies, quick service restaurants, home improvement stores, a lot of businesses that, suddenly had no traffic, no money coming in, suffering severe losses. And even then, the tenants, for the most part, kept paying their rent on time. When they didn't pay on time, they paid their back back rent later. And so if Realty Income could make it through such an apocalyptic scenario, I really don't think that a regular recession, even one combined with a trade war, would be enough to cut the dividend. Great financial crisis was also a very severe downturn for real estate specifically. Suddenly banks even stopped working, which was a very significant challenge for REITs, as they were not able to refinance their debt. They had to find other solutions. Sometimes they had to issue highly dilutive debt, and despite that, Realty Income was still able to maintain its dividend. And so again, if we're going to a recession coupled with a trade war, will that cause some pain to Realty Income? It sure will, but I don't think it will be enough to cut the dividend. The second reason why I think it won't cut the dividend is because the REIT has historically low leverage. Just like most other REITs, Realty Income has spent a big part of the last decade or two, ever since the great financial crisis, deleveraging its balance sheet to be better prepared for the next downturn. And as a result, its loan to value is today just around 35%. It has an A- investment grade rating. That's very conservative. Most private real estate investors buying comparable net lease properties typically have LTVs at closer to double of that, and they think that's conservative. So Realty Income is maintaining very low leverage despite being a very big investment firm with significant diversification. And so I think that, even if it faces some difficulties in a recession, it has plenty of room for error, plenty of margin of safety, significant liquidity to make it through. Hey, before I go into the third reason why Realty Income's dividend is safer than the market appears to think, can you please click the like button, subscribe to the channel? Helps me a lot to keep growing this channel. Thanks so much in advance. Okay, the third reason is that the REIT is better diversified than ever. And as I mentioned earlier, I think that this is a negative thing in a way, especially for total return-oriented investors like me who attempt to beat the market. It makes it harder for the REIT to keep growing. If you're jack of all trades, it's you cannot be an expert at everything. You're a higher risk of making poor decisions. So it reduces the chances of outperforming the market. However, it is fair to say that it does reduce risks as well. Now the REIT is not just putting all its eggs in one basket, it's also invests across Europe in data centers, in vertical farming, and a lot of different asset types, not just traditional service-oriented retail net lease. It also owns industrial properties, some casinos, many things. So all of this diversifies risks, and the REIT scale is also bigger than ever. It's a massive REIT with, I think, over 50 billion worth of properties. I don't remember from the top of my head, but it's absolutely massive. It's one of the biggest REITs in the world. It is the biggest in the net lease space. And as a result of this, each single property, each single tenant is relatively small as part of the portfolio. And so earlier we mentioned that we have some concerns about Walgreens as an example. It's one of its biggest tenants, but even then it still only makes up about 3% of its rental income. This diversification does reduce risks. Fourth reason, Realty Income has significant room for error. And again, I mentioned earlier that it has a A- investment grade rating, low leverage, but then on top of that, it also retains about 30% of its cash flow, so its dividend payout ratio is only about 70%. It has these 1 to 1.5% annual rent escalations, providing some compensation for occasional lease defaults. Its top 5 tenants today make up only about 15% of its rental income, and so even if they all defaulted at once, the REIT would still be able to cover its dividend with recurring cash flow. Obviously, if it faced such big defaults, it would need to then likely heavily reinvest in the properties, redevelop them to release them. This would be costly. But again, since the REIT has low leverage, a 35% LTV, significant access to liquidity, it would be able to maintain its dividend while taking care of these freshly vacated properties. So significant room for error makes it much less likely that the REIT cuts its dividend. The fifth and final reason is that the REIT has exceptional management. Any REIT can do well over the short term if their properties enjoy some positive trends and the demand is growing, resulting in strong rent growth. But it truly takes an amazing management team to achieve what Realty Income has done over the past 30 plus years, massively outperforming the market, all while steadily hiking its dividend. And I think that a big reason why they've been so successful is because they're well aligned with shareholders. This is very clear if you look at the compensation structure, with the CEO getting paid mostly based on the performance of the REIT. The base salary is very small as a percentage of the total salary. Most of it is bonus and performance based. So they're very shareholder friendly. And because they are so shareholder friendly, they take a long-term approach to net lease investing. You have a lot of management teams that will seek to hit some short-term targets to get their bonus, and so this will then incentivize them to take on more leverage, invest in riskier, higher cap rate properties to grow FFO per share a bit more in a given year. Realty Income is much more long-term oriented, and having this multi-year horizon has made them make a lot of very smart decisions. And one that now comes to my mind is that they exited the single tenant office net lease business much earlier than many of their peers like WP Carey. They did so back when they could still get a decent amount of money for those properties. That was a very smart move. WP Carey was a bit late, unfortunately, in this case. I think their management is good, but it's fair to say that they were late, and as a result they got much less for those properties when they sold them, and it even forced them to cut the dividend. Realty Income was forward thinking, did it earlier. They had to rip off the band-aid back then. It hurt their growth, but it allowed them to maintain the dividend, and that's why they've done so well over the years. They've consistently taken this long-term approach to investing, and they deserve credit for it. So to conclude, my answer is no. I don't think that Realty Income is going to cut its dividend anytime soon. Of course, I could be wrong. Maybe we'll hit an even worse crisis than the pandemic, maybe a third world war, I don't know. And Realty Income will cut its dividend and I will be proven wrong. But I think it's very unlikely, despite every investment having risks. And so if you're an income-oriented investor, your goal is to maximize your dividend yield, this is one of the best REITs perhaps to buy. But the reason why we are not buying it at High Yield Landlord, which is my REIT newsletter, is because we think that some of its close peers offer a better path to higher total returns over time because they are more specialized, they are smaller in size, and this is allowing them to grow at a faster pace, earn greater spreads over the cost of capital, and despite that, their valuations are not that different from that of Realty Income. But if my goal was slowly to maximize my dividend income, then perhaps it would be one option to consider, especially if I wanted dividend payments on a monthly basis because I was retiree and relied on these payments. It's really a good name for that. But for anyone else, I think that there are better options in today's market. As I mentioned earlier, you can access my full portfolio, all my transactions in real time, and all my exclusive CEO interviews and my best research at High Yield Landlord, which is the first link in the description of this video. We post some free research as well every week, so make sure to subscribe for that. And if you want to take your REIT investing to the next level, we have a 2-week free trial to access my portfolio. Thank you very much for your support. See you at my next one. Yeah, bye-bye.